guess we'll call the meeting to order at 8:04 on December 6th for the Retirement Subcommittee meeting. The first, I guess we wouldn't be able to vote on review of the minutes then, is that correct?
Yeah, I think to be safe, we should skip it. And those minutes were from May because we did not end up meeting in September.
Okay, and then I guess we'll move right on to number 4. So then the review of pension and OPEB third quarter performance.
Great. Good morning, folks. Good to see everyone and trust everyone's well. I'm trying to remember, Melissa, our protocol here. Do you want me to share screen and bring up the deck, or?
Whatever's easier for you. I'm happy to do it if you'd like me to.
If you want to bring it up, maybe that way we don't have to do the transition over to Tyler too, and I can just flip you along here. Again, good morning, folks. So again, good to see everyone. We'll spend just a couple of minutes on from a fiduciary governance perspective. This is the quarter, you remember, where we pull in really on just a summary level, honestly, some of the actuarial information and are able to draw some state and national comparisons for you, just so you have some touch points along the way here. Obviously, there's much more dialogue with the folks at Milliman that you obviously undertake, but it's just a good way to kind of connect in as we come into the end of the calendar year. And then we'll talk, of course, about markets a little bit and look at the portfolio performance for the pension plans and the OPEB trust, and then transition things over to Tyler for the DC review. And obviously, I know that you folks aren't shy as a group, which is great. Just stop me and redirect me if something doesn't ring true. So if you could, Melissa, just scroll down here. We're going to skip the next couple of pages are just generic firm update. I'll leave that to the committee's discretion there. Nothing really telling. The merger is fully integrated, as you know, and we're up and running and completely unimpeded from that effort. So that's all well and good. So if you go to the very next page, Melissa, actually, the way we've got things, we'll do a quick update on markets and then we'll transition into the portfolio specific stuff. So I think, as everyone knows, right, obviously in the fall, and it's carried over now as we sit here this morning, markets have become a bit more fretful and the landscape has got a bit more challenging, as you all know, for a host of reasons. And we highlight those in the upper left-hand corner of the page. A lot of the initial consternation in the market centered on investors getting recalibrated to this Fed message, which, as you all know, has been evolving for several months. And the Fed, you'll remember, has two mechanisms to put forth their policy, if you will. And one relates to interest rates, of course, and other relates to so-called quantitative easing, where they're buying securities in the markets. They've already started tapering down on the magnitude of purchases each month as they begin to transition to less stimulus. And that's a process that probably takes them through the middle of next year sometime. And of course, alongside that, there's been lots of discussion about interest rates. And as you all know, the Fed controls the front end of the yield curve with the Fed funds rate and the like. And there's talk now in the markets you see in the upper right-hand corner of the page are handicapping and are pulling those expectations and the magnitude of those hikes in closer to where they were 3-6 months ago for sure. So we've got the markets handicapping probably 2 rate hikes before the end of 2022 and then maybe a few more in 2023. So that evolving policy and that messaging, has been something that investors have been spending a lot of time on. To the Fed's credit, as you all know, they've been extraordinarily transparent, and they have built up in our minds a good deal of credibility with investors and the markets because they have been transparent and they've been true to what doing what they said they've been doing. So I think that that's offered a measure of comfort, anyways, as their policy stances begin to change. There's been some gridlock in Washington, as we all know. We had the infrastructure spend. We've got the other bills pending and that legislation in Washington. We'll see all that, where that all comes out. But certainly the magnitudes of the spends that have been talked about with $1 trillion price tags elicit a lot of conversation and discussion, and that'll be ongoing through the end of the year in all likelihood, if not beyond. And of course, and unfortunately, we continue to be presented with challenges on the healthcare front. So that the markets have been a bit more tenuous. We'll see that momentarily in some returns through September. And again, it's continued largely through the fall and here into early winter as well. The counterpoint, or the thing that has many folks thinking that 2022, all things equal, can be an okay year, centers in many ways on the strength of the consumer financially. And you see there, if you can, Melissa, make it out in the lower left-hand corner, we plot for you a couple of metrics for financial strength. One is household net worth. You see there, the other is indebtedness, household indebtedness. And if you can make it out on the horizontal axis down in the bottom of the graphic, you can see kind of the trends there have been pretty acute since the onset of the pandemic, to the extent they both indicated good deal of financial strength for consumers. And we have seen along the way here, as you all know, these lots of pent up demand. And when, supply and product can things, at least on the margin, dampen down a little bit on the healthcare front, people are out and spending and doing things. And we think that could be an encouraging trend, and one that sustains some economic momentum into next year once we get through some of these near-term challenges. And then the final thing we'll leave you with, big picture, is just because it'll help educate our conversation around the portfolios and the managers, is what's going on in markets from a return perspective. And at a high level, you see in the lower right-hand corner of the page, this evolving sponsorship in the markets that's gone back and forth from, you'll remember at the onset of the pandemic, once stimulus came into play, that it was the big tech names, the big US equities names, and large cap growth that did particularly well. And then it took everything else, small cap, international equities, value stocks, a while to catch up. And they actually outperform from the fall of 2020 into earlier this year, into the spring, even really through the summer to an extent. And then in the fall, in the third quarter, you do see there in the lower right-hand corner, we had that reversal. So we were kind of back to the beginning, if you will, with large cap names and growth names and domestic equities outpacing their respective counterparts a little bit. And, now no surprise there, right, that you get that kind of dynamic as market sentiment kind of, shifts in and out in terms of pandemic, the response to the pandemic, the pace of recovery and the like. It's natural to see those kind of transitions from time to time. So that is big picture. If we could, Melissa, skip ahead, I'm going to, you just scroll page by page there, if you wouldn't mind. I'm going to skip ahead because, well, you know what, stay here for if you could go back for just 2 seconds, because I suspect we'll get the question. You do see there, right, the other big thing that's been written about and talked about ad nauseum is inflation. And you do see in the lower left-hand corner of the page our inflation charts, and you do see the big up ramp, right, in inflation, where we've got headline numbers running at 5% thereabouts, and even core numbers running, pretty high from where they had been, certainly during the bulk of the pandemic. And for all the reasons advertised, right? Supply chain constraints, lots of pent up demand, policy having some implications on that. And we have had worrisome and somewhat troublesome levels of inflation. And as you all know, I think that the response in the markets and from the Fed has been, well, we all think it's transitory, right? Well, transitory probably to an extent, but maybe a little bit, lingering a little bit more at a higher level than first thought, and we would be in that camp. But inflation is not running at runaway levels just yet, because we don't show it here on the page. But when you look at surveys of consumers and the like, the numbers are running about what we're seeing in the prints. And what do we mean by that? Historically, when you've really had runaway inflation, you see investors and consumers really embedding very high expectations, in terms of inflation, and become somewhat of a feedback loop and self-sustaining, and we're not seeing that just yet. So we do think that these supply chain challenges and the like do kind of work their way through the system with a bit of friction here. We'll have inflation for a bit, and it'll run a bit higher than where we ultimately want or need it to be. Long-term data in the market suggests that if you look at break-even rates, for example, that we're going to get a number down in the mid to upper twos, which is very consistent with history ultimately. So something to be mindful of, but not something, again, that we think takes the next wave, if you will, of the recovery offline. So I just wanted to mention that quickly because I can imagine something that everyone's been reading about. And then if you quickly go to the page, Melissa, I think you just had, just so people see it here, and then we'll transition over to the portfolios. So you've got their returns for the quarter and year to date. So you see there the encircled numbers are Q3, and the bar charts are the year to date numbers through September. And you do see they're starting with fixed income, on the first half of the graphic there on the top. You see the fixed income markets, the broad fixed income markets were essentially flat in the third quarter. And you do see actually down a bit year to date, down 1.6%. That's for the obvious reason, I think, as you all know, that interest rates have generally pressed higher. And obviously higher rates, all things equal, are a headwind for fixed income returns. A little bit of incremental return in the way of some of the high yield markets, but nothing all that dramatic. The gray bars in the center of the graphic show equities globally. And you do see there, all things considered, US large caps kind of leading the way. Small caps having a decent year, although I will tell you in Q4 to date, small caps, particularly since Thanksgiving, have actually struggled a bit. And then you see the international developed markets, okay. And then the emerging market story, I think, as you all know, you see they're actually down a touch for the quarter more meaningfully and year to date, and really centering on the story in China. Right? We've had the situation with the Evergrande property company. We've had the government coming in and being somewhat more adamant with regulation and their intentions, and that has pressured Chinese equity returns, which are a big part, as you know, of the emerging markets. And moreover, there's been a bit of a contagion effect into other segments of the emerging market arena as well. And then you got the so-called reopening categories, right? So real REITs, real assets, commodities, right? All things equal, when you think about just the inflation backdrop, more recently has been a fairly conducive to returns in some of those segments. But taken together, if you kind of run your finger across there, right, with the encircled numbers there, a pretty modest Q3 on the return front for sure, but still fairly healthy numbers calendar year to date. Again, maybe fixed income is the exception there. Let me pause there for a minute before we transition over to the portfolios and some of those details. Anything from the committee, just big picture, economic, returns,
Chris, when do you see interest rates, the first hike in interest rates?
Yeah, the markets, Kevin, right now, and I think we would agree with it, are handicapping something in the back half of 2022, right, is when at least on the front end, when the Fed probably first takes action. They've been pretty adamant that they want to complete the quantitative easing efforts first, which should take them through the middle of next year. So it's probably, you don't see a definitive hike from the Fed until the, maybe next summer or in the autumn timeframe. And then from there, you may see multiple hikes into 2023, and then base rates beyond that, right, will be just kind of a byproduct of that expectation. So the 10-year today is at 1.4%. Our sense is it probably hovers somewhere around there, in the interim, and that most rates are, reasonably well behaved beyond the front end of the curve until we really have that campaign take hold.
Amy, does that kind of align with our view from our investment bankers? Is it Morgan Stanley, or who do we use? Is it Morgan Stanley?
Investment bankers?
What's that?
Our investment bankers?
Yes.
You mean
Right, so who do we use for funding for the bonds?
Oh, we have, US Bank.
Okay. Have you talked to them about their view on interest rates?
Sure.
And do they kind of align then? With the second half of 2022 as an interest rate increase?
Oh, I'm sorry.
Check, but our bond advisor just recently sent me an email about, he just closed on some bonds with an interest rate. I can forward that to you,
Okay,
show you what they're seeing.
yeah, if you could just forward it to the group, that'd be great.
Kevin, I think everyone's kind of fallen in line of Fed action, one or two or three hikes in 22. I think there's more debate out the curve 10 and 30s, given, 10s at 140 and bonds sub 180, which is causing the market to a lot of opinions on whether we see a 2% bond or a 160 bond.
Yeah, no, I understand. Thanks.
Yeah, I would say that's good color, Tom, and we see that anecdotally as well, just so to kind of play on what Amy had seen. I don't read the Morgan Stanley stuff religiously, but just in kind of surveying, issuers and whatnot. I think it's, as Tom says, everyone's kind of in that camp of, again, I don't know how you define it, right, but reasonably behaved rates here, and until the Fed kind of really takes hold of their campaign on the front end of the curve. We've had this, right? I think the 10-year rates are down, 15 basis points or something since we've had some of this disruption and friction in the markets over the last few weeks from where they were. So there is obviously an element of conservatism kind of baked in today at a 140, if you will. All right, if it doesn't look like there's any other questions, so we'll keep moving along. If we could, Melissa, we'll scroll all the way down here beyond the more detailed content if no one objects. I think we covered all this in some form or fashion, and we can come back to it as needed. And if we keep scrolling here right into the content, should be another page or two, and then we'll be in the there we go. Yeah, so this is just what I mentioned earlier, right on the front end. And again, we understand this is a bit dated, but it gives us some points of comparison, just because I think committees like to see where they stand vis-a-vis, peer towns and whatnot. So, we're not going to, mention each and every number here explicitly, but the government plan, funded in the 70 plus range was a 6 3/4 discount rate at the point of the print here when we were able to gather the data from Milliman. We just want to try to keep things on a consistent basis. So that's why you see it run with a little bit of a lag here. And then the next two plans, if you scroll, Melissa, right, the police and the town plans as well with that same data. And the takeaway, right, is the plans are all well funded in the 70 plus range, and you've got that funded ratio at a discount rate 6 3/4. That actually is pretty comparable to peers. So if you keep scrolling, Melissa, just keep that information in hand. We jump around here a little bit. Actually, we start with some returns. So this was an interesting thing that Milliman did. They went out and surveyed the 100 largest public plans in the country. And you see there for the 1-year period ending in, this is the highlight, I think, ending in June at the very top of the page, those plans had an aggregate or an average return, if you will, of just close to 20%. It's not on the page here, but I actually did go back and pull it. So you'll remember the town pension plans over that same 1-year period returned, bear with me here, I've got the number, 20, where is it here? Give me 2 seconds. I wrote it down here somewhere. 24.6% over that same 12-month period. So kind of a decent level of outperformance. Begs the question, why, right? Why are the town plans 400 basis points better than these, seemingly big, sophisticated investors with lots of different things going on? And some of that are things like hedge funds and other things, right? Certain asset categories, timber, infrastructure, things that hadn't had the run that the public equity markets had, for example. And that had been probably this, I think, are the best explanation of the source of the incremental return for the town plans, versus those large national plans. So again, nothing to act on, just perspective for the committee, so you have it and a little bit of a sense of what's going on, bigger picture around the country. If you jump, Melissa, to the next page, should be some data points. So this is information I think that Hooker and Holcomb captured, and these are statewide averages. You can see their funded ratios in the highlighted figures, both the histogram, if you will, and the distribution of funded ratios, and then averages. So as we talked earlier, right, I think that the three town plans are in pretty good working order from a funded ratio perspective, 70+% about what you're seeing statewide. Moreover, while we don't show it on the page here, the discount rate at point in time, the 6.75% as well, was very representative of statewide averages. That number, as we've talked about many times, was 7.5%, 7-8 years ago. People have been bringing it down. It crossed the 7% threshold. We're at 6.75 or thereabouts today, if you do those surveys and look at the data. So I think that the plans are, from a high level actuarial perspective, in good working order, both from a funded ratio and where you stand with your discount rate. And then moreover, we talk quickly just about that performance comp. So again, more information than anything for the committee this morning, nothing really to act on, but that's the extent of our governance calendar collateral this quarter. I'm happy to take any questions from the committee before we spend a few minutes on performance.
Chris, could you go back to the prior slide, the one right before this?
Sure.
And then before that. Now, I just, the value of assets. Okay, now for the value of assets for police actually increased from 2000 to 2020.
Yeah.
If you go back one more even, let's see. And it also increased for the town. Now, is that what you expected? I mean, I take it that means there's more coming in than going out to pay for pensions, right?
Yeah, I think that, it's a good question, Art. I think that your run rate in terms of cash flow, and I think Lisa may have had this question at our last meeting, right? I think it's been, and Amy can jump in here too, but I do think it runs, it runs, Amy, maybe at about a slight, just quarter over quarter, bear with me here. I had to pull a couple of data points on that too. It runs, and we probably need to look at the data when we look at the performance stuff, Art, but I think you run, your ins and outs are fairly close, if that makes sense, right? In terms of the obligation you have month to month in the plans versus the size versus the contribution of what the town puts into the plans each year.
My concern, Chris, was, I mean, all right, it's good to see it's positive. That's what you want. But if you have that kind of very, very strong performance and only a very, very small increase in the actuarial value of assets, is that a matter of concern? I mean, suppose you had a normal year, you'd be going backwards.
Well, remember too, Art, right, that they smooth. The actuary smooth, right? So you don't get the benefit.
I've never seen a smooth actuary.
You don't get, unfortunately, the benefit of that, right? So you returned, call it 24% last year. You have an expectation of 6.75, right? You don't get the benefit of that full 18 percentage point increment in the year, right? To your point, they'd see the big jump up. They kind of take that and roll it back over 5 years, and you only get a credit for a fifth of it, if you will. So that's
I see. Okay.
Bounce around quite as much as your intuition might suggest. The market value of assets, indeed, right, go up by whatever the markets go up. The actuarial figures are a little bit more measured than that based on their methodology.
I see. Thank you.
Chris, I had a question.
Sure.
First of all, thank you for that. I think while you're using the most current data from the actuary, since that time, we've reduced the assumption to 665, and our actuary has recommended we go down to 625. Obviously, those changes would lead to changes in the funded ratio. And I'm just hearing something different from you than we heard from our actuary. We know you look at a smaller time frame and they're looking at a larger time frame. But can you speak to their recommendation of going to 625? Because that's one of the things that's going to be coming up in our budget. And when Kevin reported last time, he thought our actual returns were more in the 5s for total, but I'm hearing 24. So I'm wondering if we're using the same time frame, and how, as the actuary, when we do our reviews with you, and is there a way to coordinate the time frame? Because what you do impacts what the actuary tells us we need to spend on our ARC for the budget.
All great questions, Lisa, and you're right, a lot of different points to triangulate there. Let me see if I can kind of peel it back. So you're right, the 24% return is a period in time, right? It's a single year. We know markets are highly, can be highly variable, and we can have good and bad returns around that number. 6.25, the Milliman number is a number that we intend to test literally in the next month or so. I hope that meets the town's expectations. So we are just getting ready to roll out our new capital market assumptions within the next 2 to 3 weeks. And our intention for all our allocation clients, like your pension plans obviously fit the bill, is to run and test the innate return potential of the portfolios with your current allocations. And I think Kevin's intuition is right. That number probably, this is back of the napkin math, don't hold me, but that to it precisely, because we need to fine tune it. But that number probably comes in at somewhere around between 6 and 6.25, something like that. Again, absent any manager contribution, which we all know over the last several years has been a tougher get for the active managers consistently. So, we'll do that work for you in short order, and we'll have that available fairly early in the new calendar year. I hope that fits the timelines for the town. We could look to try to accelerate it a little bit, but if that's sufficient for you folks, we're going to give you those data points so you have those direct comps to what the Milliman folks are suggesting to you. I will say, Lisa, that as you know, we work with Milliman quite frequently and to go through these exercises, as you can imagine, pretty regularly. Our numbers are pretty close when, our capital market expectations firm to firm are relatively close, not exactly so, but relatively close. So yeah, I when we run your portfolios off, it's not going to say 6.75, right? The return assumption is, and we're not going to be that high, unfortunately. But but the way we kind of triangulate, and we'll show you the different kind of mixes, we'll be in those low 6s or something, and then we can have the conversation around any rightful expectations for manager contribution or not, depending on how the committee feels. And then ultimately, right, depending on where you come out with your return setting and whatnot, we can talk about the allocation reaction and if there's anything we need to do to better match both sides of the ledger, right? If that makes sense.
It does. Thank you. Amy, I don't know if I don't think you would do this, Chris, but if it's not you, our actuary, could we get the funding ratio projections and lowering the assumption rate to 625?
Yeah, I can have that, include that in her, the projections that she already did.
Thank you.
A great question, and certainly we intend to to undertake with some vigor in the next several weeks. So we will certainly keep you posted on all that.
But the bottom line is you're in concurrence with Milliman 625.
I think Lisa, for the portfolio the way it's allocated today, I think a number of certainly a bit lower than 665 is where we're going to come out again. Right? We can talk and debate manager alpha forever, and we'll do that. But I think the number is probably a bit lower than where it sits today.
Thank you.
So let's, anything else from the group on, these are all great questions from everyone and good observations. I do want to keep us on task and obviously I know Tyler has things as well. Just shut me down again if I'm going in the wrong direction, but maybe Melissa, we could jump ahead here. It's going to be, bear with me if you keep scrolling, I'll tell you where to stop. Yeah, we could stop here for a minute. I know there's a lot of numbers on the page and we don't need to go through each and every number, but I think we can make some summary observations here at the allocation level and get you through the collateral that we want you to focus on. So that, you'll see there across the three plans, relatively close to target rates. There's at point in time, right, we're in different places in terms of contribution and getting monies to work. So you'll note there, for example, the town and the police plans were running with a bit more liquidity. That was a byproduct simply of the time of their contribution. We've actually worked with Amy subsequently and spent some of those monies down as we sit here this morning. And the directives and as you can imagine, directionally what's going on over the last 2 quarters from a cash flow and an allocation perspective is when we've needed money in the plans, we've been sourcing from the overweight categories, which is domestic and to an extent international equities. To the extent that there's cash available to be put to work, it's being put to work in fixed income. Again, all with the designs in the far right to run the portfolios as close as is practical to that. You see the targets there, right? 32.5% fixed income and then equities and the other diversifying asset classes according to target. So I think we're in good working order from an allocation perspective as we come in the calendar year end. We've actually just worked with Amy more recently to set the plans up to have sufficient liquidity to get them through the end of the calendar year. So nothing more to report on that front. The only thing I would offer up in the collateral is in your deck if you had a chance to look at it. This is a good place, I think, just given the visuals in the left-hand column up and down the roster. The only manager status that we did change in the quarter was MetWest Total Return. You see there one of your fixed income managers. There's a what we call a flash memo that's included in your materials. I will summarize it for you. One of the senior portfolio managers on that strategy, who's one of 4 who works on the strategy, announced his retirement at the end of the calendar year. So that is something that we do want to highlight and spend some time evaluating. Had lots of conversations with the team there and the 3 individuals that remain behind had been investing alongside this retiring individual for the better part of 20 years. So they're fully ensconced in the process and the approach and very experienced and intend to carry on with the way MetWest has always run money. So I don't think anything ultimately comes from that, but something just for the committee to be aware of. The balance of the roster up and down the column there on the left, all on maintain and in our estimation in good working order. So that is allocation. If you could quickly, Melissa, we'll just show you summary numbers because obviously it's something of interest to the committee. And then we can pause on that. And if there's no questions, we'll just do the same very quickly for OPEB. So if you scroll a little bit, Melissa, down a little bit more, so I don't know if folks can see that, but there you go, if you can make it out on the bottom of the page. So really a kind of a nondescript quarter for the plans. You see they're essentially flat. If from a rounded perspective for the quarter, the benchmark was down about 40 basis points. Year to date plans running about in line with benchmark net of fees. You see the 6.8 number there, and still a fairly healthy absolute return 1 year through September at north of 17%. It is interesting, right? If you go back to maybe Kevin's intuition, you talk, and we get this question a lot from committees. You've got to use the 7, the 10-year number. I mean, the since inception number is before all of ours history with the plan, but it's a guidepost nonetheless. It is interesting, right? You see a lot of long dated numbers where returns are fairly healthily and consistently north of what you're being asked to, right, put into the plans now at 6.25. And we do get the question a lot, of trying to bridge that disconnect, if you will. And I think, as you all know, right, those fairly healthy returns, a 10-year return in a balanced portfolio of 9%, for example, on a go-forward basis where we sit today with valuations and interest rates as low as they are and some of the other challenges, you can kind of in your mind justify on a go-forward basis that lower return forecast. But it is of note and interest, right, that the plans do have long histories of generating numbers well north of some of the actuarial expectations, for what it's worth. Again, not necessarily anything to act on, maybe just additional data for your consideration. Anything on allocation or performance for the plans that needs more context? There's some of the individual manager details are included. There wasn't anything in our minds that stuck out as being dramatic or requiring input from us. But I don't know if the committee in their reviews or just in flipping through the materials was anything on a manager front that cropped up to people that bears a comment or two.
Chris, my only question is just going forward, just for ease to report out to the Board of Finance, is it possible to have a consolidated sheet with just the highlights so it can be presented to the Board of Finance a little bit easier rather than flipping through a bunch of pages?
Yeah, sure. Kevin, we're happy to work with you if you'd like, and we can design like a one-page summary for you if you want that just has, a couple of the high-level tick points and we'll defer to whatever you want in terms of transition that information, but absolutely, we can help you design that. And
Okay.
I'll make a note of it and we'll maybe take a crack at something to show you.
Yep, that'd be great.
All right, so with that, if we could, just because I think Melissa, right, it's on the agenda and it's I guess a more straightforward conversation, right? The OPEB trust, if you scroll ahead, just so folks see that data. So here are balances. Again, we wanted to kind of touch point into September, but you see the portfolio towards the end of November here. The only thing we'll probably do here coming into year end, if no one objects, we can probably draw the liquidity down just a touch. We can work with Amy on that. That money will likely go to fixed income, right? Because that's where we've got the most pressing underweight, a percentage point. Nothing really material, but just kind of maybe trim that out and start the new calendar year a touch closer to the explicit targets. But otherwise, the portfolio is in good working order, right? And kind of running, I think, consistent with your edict. All indexed, all at Raymond James, and the indices kind of doing as advertised. If you skip ahead, Melissa, to the next page, right, you'll just see that's just the September data. If you go, I think one more, you'll see the performance information. Yeah, right. So there's you see there returns down in the middle there. We've talked about it a million times, right? I think Tom's asked this question rightfully too through time. There'll be a little bit of tracking error through time with the indices, right? There's these ETFs, right, trade to NAVs, and there'll be bits of fluctuation and, fair market pricing in the international markets and other kind of quirky technical things that'll take the plan a tenth or two on either side of the benchmark, but you do see their longer term, no surprise, right? The plan's got, 10, 15 basis points of expense or thereabouts. And no surprise, you're running just at about those thresholds versus the benchmark longer term. So pretty decent, I think, all things considered, top line numbers here too, right? If you think about just the absolute return compounding over the last 10 years at 8.7%, it starts to add up. And I would, at $22.5 million, at the end of September anyways, and north of that now, certainly the town's, stature in terms of the good strides you've made on the OPEB trust is fully intact. You've got one of the larger OPEB trust plans in the state, I think, maybe some of the big cities aside. And we're in perfectly good working order, and have gotten had the foresight to get off to a good start on this and fund it, and the plan's grown, the fund has grown nicely. So really not more to report there to the committee, but happy to take any questions you may have.
I had a general question. Maybe this is for Maria. Board of Ed, are we seeing a larger number of retirements than expected, or are we on trend?
So, it's so hard in our world because unlike sort of a teacher's contract, where they give us a lot of advance notice, we might get 2 weeks notice, we might get 6 months notice. We definitely, I think, had sort of an error of hiring, if you will. So we definitely have had a lot of more tenured folks retiring in the last year or two. So, folks with 25, 30, 35 years of service. But again, I think based on sort of the longevity of folks in our workforce and their age, we're just sort of hitting a bit of a period of time where I think we're going to have perhaps more than normal, but it's based on eligibility.
And those are already baked into our it's not more than our actuary had anticipated.
No, exactly. Right.
Thank you.
Yeah, you're welcome.
It doesn't look like, Mr. Chairman, there are any other questions. So if not, I'll, with your permission, turn things over to Tyler for the DC portion.
Thanks, Chris.
Morning, everyone. I'll talk a little bit about the defined contribution. This quarter is our third quarter governance calendar. And so this is typically when we have the record keeper in. I think that the discussion is that the planning part, the discussion around education advice would be done more internally. But you also went through a pretty exhaustive search previously. So you spent a lot of time reviewing the services, reviewing the record keeper itself. At ICMA, now Mission Square, again, just a rebranding there. And so I won't spend a lot of time on the record keeping services update. What I did include this quarter is a review of their cyber controls or cybersecurity, given the DOL's guidance around cybersecurity and third-party providers. So I'll touch briefly on that, and then I'll talk a little bit about plan design within the municipality space. It's a little trickier around design. Obviously, a lot of the design is negotiated from a collective bargaining standpoint. So there are some things that we can have a discussion around with respect to the 457 plan around design. So I'll talk a little bit around that. But again, we're benchmarking it against 401k plans, so it makes it a little bit more challenging. But on the next page, Melissa, this is something that we do recommend is done, and I can coordinate with Maria and team around making sure we allocate the right resources. So Laura Hancock at Mission Square is sort of the education provider, and so we want to have a conversation around how to get in front of individuals, how to make sure they understand the plan, make sure they understand how to utilize the investments, make sure they understand the resources that are available to them. So it is important to do at least at minimum once a year, and so we can have a conversation around doing that with respect to working with Mission Square on providing those resources. On the next page, we go into a benchmark of plan design. So we use, and this is obviously the 457 plan. There isn't, unfortunately, a study around 457 plans. So what we use is the Plan Sponsor Council of America's survey around 401k plans to kind of give you an idea of how your plan benchmarks against other defined contribution plans in the industry. And so what you see here is on the top is kind of a benchmark around the types of services and investments that you're offering to employees. We benchmark it in two ways. One is similar size plans, and then all plans in the industry. And what you'll see here is it's asking questions like, do you offer specific participant advice? Are there managed accounts within the portfolio? Do you offer a self-directed brokerage window, which allows someone to get access to, any mutual fund that they, in the 10,000 plus mutual fund universe? Obviously, you offer target date funds, risk weight funds. Company stock obviously irrelevant here, but what you see here is you're offering the target date funds, which is in the majority. The rest are kind of in the minority with respect to advice and managed accounts. We obviously can have a conversation around if that does interest you. we can definitely talk more about offering those types of tools, but you can see you're in the majority in what you offer and don't offer. And then when we look at the total number of plans, you're right in line with the benchmark as well, offering 18 plans compared to 24 or 19 actually across all 401ks in the plan. So obviously in the 457, it's just an employer contributed plan. So there's no match that employer contributions are on the 401a side. That being said, you do offer Roth, which you can see 70% of plans do offer a Roth feature. So you are offering the ability to make after-tax contributions. You do offer loans through the 457, and the loan number is manageable. The one thing to consider, again, we're seeing more and more organizations, companies, institutions gravitate towards auto features. We can have a conversation around, auto enrollment in the 457B plan. And what that is that, as someone's hired, they're automatically enrolled into the plan as opposed to proactively electing to be in the plan. So you can decide, say,
Hey, Tyler, I thought we set that up, or was there a reason why we didn't? Because there was quite a bit of conversation around it.
So we get this information directly from Mission Square. I'll have to double check on that. So because they have obviously the plan document work, unless it happened beyond the 6/30 date, I'll confirm with them, Kevin, on that.
Yeah, just from previous discussions, I know we had discussed it quite a bit about having that set up as automatic enrollment. Maria, would there be anything to say we wouldn't be allowed to do that?
I think so. And we did have a lot of conversation with that. So we should definitely check on that, because I thought that was the direction we were heading in.
Okay. So if we could just make that a note to discuss that next time about applying that to the current plan, that'd be great.
I will A, confirm, and B, if it's not, and we can make it a point of discussion during the next quarter, because again, we're seeing better results with auto features versus non-auto features. So I will confirm that, and then again, the next page, you can see you get a little idea of what the 401a plan again. It's unique in that they're required employer-employee contributions. So it's obviously a little bit different than, say, a typical 401k or 457 plan. If you go to the next page, Melissa, the DOL back in April did provide some guidance around selecting and evaluating service providers, third-party service providers, and it was really kind of three-pronged approach. And this is around cybersecurity, of course. The first is, okay, what should a fiduciary do when they're selecting and monitoring third-party providers? What kind of questions should you be asking around cyber controls, cybersecurity? The middle guidance was directed at the actual service providers. Here's some best practices you should have, right? Third-party audit. You should have some guidance around how you store data, how you encrypt data, how do you document any issues that occur. And then the third leg of the stool, so to speak, was some guidance around what employees should be doing around protecting their data, right? If there's multi-factor authentication, set that up. Be wary of any free Wi-Fi, etc. The one control that you have is the one to the left, and actually in the back of the deck. And Melissa, I apologize. I'll force you to just go to the last few pages of this deck. We actually included. We took the DOL's tips on right here. Yeah, we took the DOL's tips on what questions you should ask around cybersecurity, and we sent it to all the record keepers we work with, and we work with over 20 different record keepers, including Mission Square ICMA. And so what you'll see over the next few pages is we ask the questions that the DOL wants answered, essentially. Understand the standards, practice, and policies and audit results. So Melissa, on the next page, you can see the response back from Mission Square around their standards and their audit results. On the next page, we actually ask around litigation, any breaches that have recently occurred, what kind of insurance is set up, all the things that the DOL wants you to understand. Again, I can't, nor I think Mission Square can guarantee that there will never be a breach. The important thing is that we at least document these answers, document that you've asked the questions. We also, look at these and receive the answers from 20 other different record keepers. And there was nothing from the responses that we saw that stood out as a concern. Again, we are not a cyber tech organization, but we can at least compare the responses that we get from the different record keepers, the Fidelities of the world, the Empowers, the principles of the world. So there were no issues, no big concerns. I think it's important that this is documented, that we did look at it, and again are comfortable with the responses that we did receive. So sorry, I'll go back to, I think it was perfect. If you want to go back a couple pages, one more page there, and that next page, excuse me.
Tyler, before you get off cyber, if I could just enter a footnote, you have to assume that you will be cyber penetrated. I mean, anything can be. I mean, if they're penetrating our national security organizations, our intelligence agencies, the most sophisticated banks in the world, they can penetrate us. And we need to have a plan of what would we do when it happened. That is simply that the day comes in, you have been penetrated. We're no different than anyone else, which are being routinely penetrated all over the world every day. So it would be prudent to assume someday that could happen to us. And what will we do when it happens? I mean, this is something Maria has to, right from the very first hour, have a game plan. And how do we manage it? I just leave it at that, but no point belaboring it. We've talked about it in the past, but simply we have to assume penetration, compromise, and know what we're going to do once that takes place.
That's a great point, Art. And I think, again, there's so many different ways that this could occur. Mission Square can be breached, right? So data can be leaked from Mission Square itself. The town is providing payroll information and other information to Mission Square, so that point can be breached. And of course, an individual who may have a large balance, they can, Mission Square can be doing everything appropriately, and someone could have enough information to be able to pull money out of someone's accounts based on something that an individual did, like provide all their information to a fraudulent person. So there's a lot of different points. The best we can do, obviously, is, yes, you're right, have a plan, but also, again, ask the right questions. What I also have been recommending is there's a lot of things set up at Mission Square to help an individual protect their assets. Multi-factor authentication is a great first step, right? But it's only as good as if you've set it up. And most people haven't registered. And so what I do recommend, and I can coordinate this with Mission Square, is a sort of proactive educational campaign around protecting people's accounts, protecting people's data. Most people, the first time they've registered online is when they want to take money out, right? And that's what also everyone else is trying to do when they're the fraudsters and the hackers of the world are trying to do as well. So the more people can be proactive around setting these protections, this layer of protection, the better off I think they will be.
Well, yeah, hygiene is absolutely important, but then this goes beyond simply these accounts here. I mean, ransom accounts all over Connecticut, towns are being compromised, and once it happens, the ramifications are huge. You no longer have confidence in this town because its managers failed to protect its citizens, and then you have massive political repercussions. You have loss of confidence. I mean, all kinds of bad things happen. So I applaud the hygiene. And this is simply one of maybe 18 or 20 different methods by which people penetrate towns for ransom attacks, for whatever, directly or indirectly, you're right. And it's a simple point that when it happens, a town has to have a reaction plan, both to manage the situation, but also to instill confidence in the citizens of the town that it is capable in this area. That's all.
Yeah. And if you'll recall, the last 2 years, I think, we've done a cybersecurity update to the Board of Finance in the Board of Selectmen in executive session just to talk about sort of what we're working on, our policies and protocols. In terms of your specific question about, what being prepared for when an incident happens, we do have an incident response plan. What we've been talking about over the last several months is actually doing sort of a tabletop exercise to run through that plan and really practice, because that's really what I think the next step is, beyond having something on paper. And that was talked about at Public Safety Subcommittee. And I think just with COVID, we were trying to figure out timing for running such a tabletop exercise, but that's definitely something we need and want to do.
I don't mean to spend too much time on this. The point is people in security, the military, the intelligence tell you all the time, if you've never rehearsed it, you're not ready, and we have never rehearsed it. So I won't belabor this, but we have not rehearsed what we would do in the event of a cyber attack. And so therefore, as far as I'm concerned, we are not prepared. I mean, I don't mean to get off on a tangent on this right now.
All right, but let's go to page 42. The next 2 pages, excuse me. You can see this is the balances of the 457 plan. So what I'm looking for is significant changes in asset allocation here. The plan moved from about 14.6 to about 15.6 million from March. Again, obviously we just transitioned over to the ICMA, added some new investment options, and so there's some investments that aren't invested in yet, but I expect that to grow. And then, as we've seen in the past, 20% or so in the stable value fixed vehicle. The next highest is the index, the S&P index fund, and then of course the target date funds. If you look at the next page, is the 401a, and then again, because that's the newer vehicle, more money in target date funds, more people gravitating towards investments in the target date fund, representing about 90% of the assets. And then the Board of Ed plan after that historically has had a bigger portion in the money market stable value vehicle as opposed to the rest of the investment options. But similar story there, stable value, then target date fund and S&P 500. If you look at the performance on page 45 there, so what we're showing you is the T. Rowe Price target date funds. Just to remind you here, T. Rowe Price again has a glide path, a decrease in stocks, an increase in bonds as you approach retirement and beyond. They just announced about 5 or 6 months ago that over the next 18 months, so ending I think towards beginning of next year, that they're increasing their equity position further away from retirement and further beyond retirement. The rationale behind this is that they looked at the data. So if you think about a glide path, how you build an asset allocation that evolves over time and evolves as someone who's aging and moving throughout their career, a lot of data goes into the creation of that glide path. And what I mean by data is, how people live, how people save, their behavior, again, how they spend in retirement. And the original glide path from T. Rowe Price was built in about 2002, and they found last year that a lot of the assumptions changed a bit. One of which was mortality. Actually, the mortality increased by about 2 years. So if people are living longer, they feel that you need to take a higher equity position further away and further beyond retirement. They also saw that savings rates were a little bit under what their assumptions were. Originally, they assumed that people would save about 15% annually, both employer and employer dollars. And the reality was closer to about 12.5. So that helped with their decision to increase equity. Again, it's an idea of underfunded status. So you increase the equity amount. And then behavior as well, actually. If people were, based on volatility, moving in and out of the markets and in and out of these target date funds because of sort of a fear index, right? That would make the target date fund useless if people are not utilizing it and staying in. And they found that most people who invest in target date funds do stay in the target date funds themselves. So you have a fairly high equity position. You can see that's been beneficial for the peer ranking. So what you see, Again, how you read this is the top line is performance on a quarter, 1 year, and then annualized on a 3, 5, and 10 year. That's net of fees, of course. The index it compares itself to below that, it's median peer ranking, peer performance, median peer performance below that, and then peer ranking. And what you'll see with the T. Rowe Price funds is they've been the top performing fund pretty much in most categories, and then longer term over the 10-year top performing, top decile performance across the different vintages. If you go to the next page, you can see that continues on to the all the way through the 2055 and of course the 2060 fund on the next page. So we do have a maintained status on the target date funds. If you go to the core menu on the next page, Melissa, you can see we do have so this is the start of the bond portfolio. So you can see that the bond index, again, it's a peer ranking against the entire broad core fixed income market, not just index funds. And so that Fidelity US Bond Index Fund is performing in line with the index, and no big concerns there. Some slight underperformance in the quarter for the Western Core Asset or Asset Core Plus Bond Fund. Again, that's just some of their non-US exposure given the US dollar strengthening, but you can see longer term performance has been fairly positive. MFS value, some slight underperformance in the 1 year. A little bit of energy stocks detracted a little bit from performance, but longer term still doing fairly well. If you go to the next page, the indexes are performing in line. The T. Rowe Price Growth and Explorer Value performing fairly well against peers and against the index. So no big concerns there. If you go to the next page, I'll touch on one fund which is had some underperformance, and I know the investment team has been talking a lot about this fund, but that Eaton Vance Atlantic Capital Fund, you could see a longer term underperformance versus peers versus the index. This is a lot of that has been the result of a very unique 2020. Sort of the short term has weighed significantly on this fund. This strategy focuses on businesses with a history of displaying high profitability, consistent earnings. They like healthy balance sheets, and when we look back at 2020, non-profitable businesses outperformed profitable businesses by about 60% in at least that 2,500 growth fund. So we believe and still have confidence in the philosophy. It was just a very unique 2020 that's weighed on that longer term performance. So we'll continue to evaluate that fund. Again, we're giving it a little bit of longer leash with respect to the performance, given how unique the market was in the growth space. And so we'll continue to update you as things change. But we do still have that fund on maintain and don't have any immediate concerns with that portfolio. Actually, it's actually done fairly well during a very unique fourth quarter or volatile fourth quarter. So no recommendations to change the portfolio. The international fund performing fairly well as well. So I'll pause there to see if there's any questions about a particular manager or the defined contribution space in general.
I had a question.
Yeah.
Tyler, first of all, thank you very much. That was a very helpful summary. I know most of our employees are in pensions and some of these are supplementary, but as we transition, or if we transition to defined contribution as opposed to defined benefit, can you talk about any role you see for annuities, if any?
It's a great question, because actually the industry has been given a little bit more guidance on what's called income products, annuity income products. So there are products out there called guaranteed minimum withdrawal benefit annuities. So essentially you're putting your assets in an annuity, and it will guarantee, say, 5% for your lifetime based on a watermark, right? If you had $100,000, it'll guarantee you $5,000 a year based on that $100,000, even if the portfolio dips. They're expensive right now, Lisa. So those products typically can be 1.5% to 2%, because obviously you're paying for that protection. And they really came out of the 08-09 market, 07-08 market. And if you think about a high cost product like that and how the market performed since then, it wouldn't have been beneficial, right? But we are this industry, the defined contribution industry, spent so much time on asset accumulation, and we're realizing with the big shift in baby boomers and people retiring, we need to start thinking about retirement income and how do people stay in the plan and draw it out. So we were recently provided with some, I say we, the industry was recently provided with some guidance around annuity income products. There are options within the ICMA portfolio. There's something called Income Flex, which is actually backed by Prudential's insurance that could be offered through this. It's just still a little bit expensive. The portability issues are still there, right? So, if you ever left or moved around, how do you take it with you? How do you continue that benefit? But it's a great question. It's top of mind right now, both at our firm, but also in the industry. So as we become a little bit more comfortable with annuity-like products, we'll bring those to the forefront and have a conversation around it. But it's at least it's pensioning the DC plan. We're coming full circle, right? We have pensions, and then now we have DC. But now, how do we protect people from themselves or from the down market? And it's then adding back annuities that can sort of make the DC seem like a pension plan.
Yeah, it's about where the risk lies, I think. And, you see in the private industries, some of them are starting to offer annuities for just the reasons you described. And if we do, right now, we offer a pension, so it's less important at the town level. But if there is a transition, it's more a long-term thing to evaluate. I agree. And thank you for keeping on top of it.
Yeah. And again, I do expect, given the guidance we've received by the regulatory, the DOL, I expect this to become more competitive, the space, and therefore, competition will drive more reasonable costs. Because right now, you can add an annuity-like product that has, equity exposure, and the fees are around 2% or so. And so, what's the benefit? Is the risk of having this high cost, or is it the benefit that you can, protect against a downturn in the markets,
or a longevity risk? I think more as the cost as an insurance against longevity risk. That's
absolutely
another way to think about it.
Yep.
Lisa, it's the opposite of indexing, right? So indexing is very low cost, right? The annuities are going to be, as Tyler pointed out, in the 2 to 3% range, right? The only thing you're doing is you're hiring the insurance company to manage your money for you.
Precisely, but it's for those who might not be sophisticated investors. It's a longevity hedge.
Yeah.
There are certainly different philosophies on it, and but I do appreciate you guys following it and looking into it and evaluating as we go forward.
So just a thought, and it could spend about 5 minutes of next meeting's time. I know ICMA, their Mission Square does have an advantage, an income annuity product. I could just show you what it looks like, show you the cost of it, so you have a concept of what it looks like now, and its features, just so that you so documented that you looked at it. And we don't currently recommend it, but we can at least show it to you next quarter.
Sure, thank you. I understand the cost issue, but I think it is something to monitor over time, especially as pensions just start disappearing.
Perfect. That's all I had.
All right. Any other questions for Chris or Tyler? No. So then, Melissa, it doesn't look like we're able to vote. Is that correct on the minutes or the meeting schedule?
So at least in terms of the schedule, and we could probably do the same for the minutes, but not as time sensitive. For the schedule, I think we can probably, if you're comfortable doing it by consensus of the members that are present, especially since it's not deviating from our normal structure and format that we normally adopt. And I did thank you, Tom, for pointing out there's a typo here. It says 2020 instead of 2022. So we'll make sure we correct that. But if you're comfortable, I think we can go ahead and approve it. Otherwise, because we're supposed to file by the end of January and we're not scheduled to meet until February, we would have to schedule all of these as special meetings next year.
Okay. And it looks like it's the week before the Board of Finance meets. Is that correct?
It should be, yes. It should follow the same sort of format that we did this year.
Okay, all right. So for consensus, do we have to just call a vote or?
Just if anyone has any suggested edits or concerns,
Okay.
we can just leave it as is and we can go ahead and file it.
All right.
Can we just note that it was consensus of the participants that we proceed this way? That might be a good way just to have a note in them, a record made, even though it's not a formal vote, that the participants agreed that those meeting dates and time were appropriate for the coming year.
Yeah, thank you, Art.
Perfect. Thank
Okay.
you.
All right, without any further business, do I hear a motion to adjourn?
This is Tom Potter. Make a motion, we adjourn.
All right. Thanks, everyone. Have a great week.
All right, thank you.
Thank
Thank
you.
you. Bye.